All right, so that's corporate opportunities. That's one of the ways that this sort of thing comes up, and one of the ways that directors and officers have gotten themselves into trouble violating a duty owed to the corporation. Another way that this comes up is in self-dealing and competing. Self-dealing occurs when the director or officer puts themselves in a position to take some kind of improper stake in the business of the corporation. It's kind of rare and a little bit strange, but the best example of it I can give you is if a director or an officer is lending money to the corporation without full disclosure to the board of directors. Then basically what they're doing is they're buying a stake in the success of the corporation in a way that's improper. There's nothing wrong with investing in the corporation if you're a director or an officer, but the way you do that is by buying shares of stock, not by becoming a creditor of the company. You're looking out for yourself, your profitability of your own dollars, by lending it to the corporation ahead of being loyal to the corporation and doing what's in its best interests first. Competing is kind of the opposite of that. If, for example, you're on the board of directors of a company like, Pepsi, and at the same time you are buying shares of stock in Coca-Cola and participating as a shareholder in that company, well, you're kind of competing with your company. Shareholders, you'll notice, by the way, do not owe any duty of loyalty. So you can own shares of stock in Coca-Cola and shares of stock in Pepsi, and that's perfectly fine. But you can't be a board of directors member of one and own shares of stock in the other. There's a problem there. There's a competition problem. All right. So that's the duty of loyalty. Those kinds of what we normally call a conflict of interests, right? Those are the kinds of things that violate the duty of loyalty. The other duty that's owed by directors and officers is called a duty of care, and this is a term that we used when we talked about negligence. We talked about how everybody owes each other a duty of care, right? Same kind of deal. It's very similar to what we talked about then. Basically, what the duty of care means here is that a director or an officer has to use some care and caution and diligence as they fulfill their duties as a director or an officer. So, what did I tell you about negligence? What we're talking about is when someone does something because of stupidity or because of carelessness. Same thing here. The duty of care that a director or an officer owes to the corporation means that they can't be careless or stupid in fulfilling their duties in that role. All right? I'll give you a couple examples of how this has come up and how some directors and officers have gotten themselves into trouble. Failing to attend board meetings. Right? If you're a director, you got to go to the meetings. If you're just shirking your duties and not showing up, that's considered a violation of your duty of care. You're not being diligent, you're not being careful, you're not being responsible as a director. One of the ways that officers have gotten in trouble is a lot of times officers will be vested with some management power that'll be delegated by the board of directors, and then the officers will delegate duties and hire people underneath them. So we talked about having an IT guy and having somebody hire an IT guy. That IT person is probably not going to be an officer. They're probably just going to be an employee. But there may be a chief information officer or a vice president in charge of information technology who is an officer, but they're going to pass some of those duties on to an IT professional, to help complete the functions that that department needs to complete. One of the ways that officers have gotten into trouble with the duty of care is failing to supervise those employees. So an employee doesn't owe a duty of care to the corporation, or a duty of loyalty for that matter, but an officer does. And part of being diligent and cautious in exercising your duties as an officer is supervising your employees and making sure they're not, doing stuff they shouldn't be doing and screwing things up to the detriment of the corporation. All right. So those are a couple examples of how duty of care comes up. There is one sort of big, I don't want to call it an exception, so I've just called it a but. So duty of care, but remember, there's something called the business judgment rule, and this is something that directors and officers use to protect themselves when they're accused of violations of their duty of care. So here's how this works. If you have a director who's in charge of, say, new markets and expanding, markets for whatever product the corporation makes, and they do all this research, they're looking for a new market, and they think they've decided that the best thing to do at this point is to expand into South America. We're going to start selling our product in South America. And they go to the board of directors or whoever else needs to make that decision. And they pitch this idea. They did all the research. They're very well prepared. But the bottom line is it's a risky venture. It's going to cost a ton of money to bring the product to this new market. It's going to cost money to market it there. I mean, you're not just going to put it on the shelves and hope people buy it. You're going to do some advertising. So it's a risky venture, but they've done the research and we're pretty sure this is going to work. So what do you know? They take the risk, they spend the money, they put the product in market in South America, and they don't sell a single unit. They lose a fortune. They take an enormous loss on this whole thing, and the shareholders are furious. And they're out for blood. And they want to know whose responsibility, who made the stupid decision to do this. And of course it all comes back to this officer who pitched this idea. And they're going to say, well, you were an idiot. This was stupid. It didn't work. So we're going to call this a violation of your duty of care and say that you should have known that this wasn't going to work. And the officer is going to say, well, I'm protected by the business judgment rule. If it's a mistake in judgment, right, or something that was a risk and there was risk involved, as long as the director or officer in question was cautious and careful and did the research and didn't just, say something stupid or make a guess without being prepared and informed and educated and diligent on the issue, then they're going to be protected. Say, hey, this is business. You take risks in business. And sometimes you make the wrong decision. But we're going to protect business leaders who take risks and make bad decisions as long as they're not negligent in making that decision. So an officer who discloses everything to a board of directors and says, this is a risk, but we think it's going to pay off, and it doesn't, is protected. But an officer who goes to a board of directors, hasn't done their homework, and only gives half of the story to the board of directors, they're going to have a hard time finding some shelter in the business judgment rule. But it's out there, and it's used a lot to protect business leaders when companies make a bad investment and things go horribly, horribly wrong. Okay, so those are the duties owed by directors and officers, which means that the only thing we have left to cover is dissolving and terminating corporations. And again, we're going to keep this pretty short. The important thing to remember about corporations is that they're designed to operate perpetually, right, forever. They don't ever have to dissolve. They're designed to operate till the end of time because owners can be traded in and out seamlessly. We can have new shareholders every single day, and it doesn't change a darn thing about the way the corporation functions. Also, just remember that when it comes to dissolving, we need a shareholders vote to dissolve the corporation. Unless some dissolutions can be court imposed, involuntary dissolution of a corporation. It's usually used as a punishment for a corporation that has been doing something unethical or illegal or improper in some other way, or is in a bankruptcy type situation that they're not going to be able. Usually in bankruptcy, you're in bankruptcy because you want to continue doing business. You just need protection from creditors in the short term. Well, in a court-imposed dissolution, sometimes it can just be because whatever you're doing, it's not profitable. It's not going to be profitable, and the court is not going to allow for a restructuring following bankruptcy. So instead, there's going to be a court-ordered liquidation of assets and a dissolution of the corporation altogether. So that's possible. It's rare. Usually, bankruptcy is done for the purpose of restructuring and going on with business after you've gotten some level of protection from creditors. But it doesn't have to be that way. Sometimes it goes the other way, where you ordered to dissolve altogether. So those are the issues about corporations that we need to discuss. I'm not sure how well I did on time. I haven't really been paying attention, but I hope you're able to follow along on this. It's much, much, much better to have these discussions in class, and I'm sorry we had to do it this way, but it was the best way to kind of to keep us on track. So again, keep an eye on the Blackboard message board for questions about this material from your class, and also from me about the Best Buy bylaws and some other, maybe I'll post some other things for discussion as well. If you want to participate in that, I'd appreciate it.